Hello, everyone. Great to see you this evening. My name is Karen Tucker. I'm the Churchill Club CEO and a member of the Board of Directors. Welcome to tonight's program called Mergers and Acquisitions, War Stories and Predictions from Industry Leaders. The industry leaders with us tonight are Marc Brown, Managing Director, Corporate Development, Microsoft. And immediately to his left, Charles Carmel, VP of Corporate Development, Cisco. And then we've got David Lawee, VP of Corporate Development from Google. And then on the end down there, Rich Wong, partner at Accel Partners. And of course, here our moderator, Steve Smith, Senior Managing Director, Arma Partners. I would like to thank the generous sponsor of tonight's event, Skadden Arps, Slate, Meagher and Flom. Skadden Arps has been a valued partner of the Churchill Club for over a decade now. And our champion is Ken King, who is here in the audience. And I heard Steve say prior to the program that Ken invented M&A, so you might want to ask him about that. He was indeed named by California Lawyer as one of the top corporate and M&A lawyers in the state. I would also like to thank Microsoft for opening their doors to us this evening for our meeting. Quickly, a word about upcoming programs. Next week, on December 17, we present a breakfast program called Startup Growth Strategies for the New Order, with a top-notch panel, including Dado Banatao from Tallwood Ventures and Bill Coleman, the former CEO of BEA and Casat. Marc Leahy of Fenwick & West will moderate that program. And on Friday, January 15, we present Journalism After Print with another great panel, including Krishna Bharat of Google News, Ken Doctor of Accel, Mike Masnick of TechDirt, and Rebecca Buckman, who's ex-Forbes and Wall Street Journal, and that will be led by Sam Whitmore. And then finally, on Wednesday, February 17, it's a Churchill Club premiere event, an evening with the CEO of Netflix, Reed Hastings, in conversation with the former CEO of the Walt Disney Company, Michael Eisner. Don't miss that one. Please do stay tuned for further program announcements. We're working on lots of other exciting ones for you, including the top 10 tech trends and lots more. Finally, a final announcement. If you are not a member of the club and you enjoy this evening's program, I encourage you to consider joining us. We offer memberships for both corporations and individuals, and you can find all the information you need and more at churchillclub.org. Steve Smith has been in Silicon Valley for 36 years, in tech M&A for 21 years. And he and his teams have done a couple of hundred deals over that period. For the past few years, Steve has been with Arma Partners. Arma is a boutique investment bank with offices in London and Palo Alto. Arma is well established in Europe as an M&A advisor in technology, media, and telecoms. And Steve aspires to do the same thing for the firm here in the U.S. He previously spent 14 years at Broadview, as you can read in his bio in your program. But what you won't read in that bio is that Steve is a self-professed obsessed golfer in daylight, darkness, rain, shine. In fact, he was once named Golf Nut of the Year by a prestigious group called the Golf Nut Society. That's quite an achievement, Steve. Steve has led many Churchill Club programs in the past, and we're honored to have him back on our stage. Please help me welcome Steve Smith.
Thank you, Karen. I was asked to give you some kind of tidbit that wasn't on my bio, and I went way too far. I can see that now. But anyway, enough about golf. There's a lot of stories that could be told, but we won't waste your evening on that. That's not why you're here. Again, my thanks to everyone who helped make this possible. The club's done a great job for years and years of pulling together a great audience for great programs and helping us pull together great speakers. Tonight's no exception. What a great facility. Thank you, Microsoft. Great food, great wine and drink. Thank you, Skadden Arps. And thank you to the panelists who agreed to do this. This is not an accidental panel, as you might guess. These really are leaders in the field of taking advantage of the merger and acquisition process. Just a few statistics to get you started. These three companies do about $120 billion a year in revenue. That's $10 billion a month. That's pretty good. They have a $600 billion cumulative market cap. That's three companies that are represented right here. They have about $100 billion in cash sitting in the bank. That's pretty interesting. Are there any sellers in the audience that heard about that $600 billion market cap and $100 billion in cash? They have annual cash flow of about $40 billion. That's pretty good, too. I don't think I've ever been fortunate enough to get a panel together that represented this much of the technology industry, let alone the gross domestic product of the United States or the world. They've also done $10 billion worth of announced transactions so far this year. That's pretty good. And it's a down year. We also have a truly Tier 1 venture capitalist here in Accel Partners and Rich. You might think they're just another venture capitalist. Well, you probably haven't looked closely enough. In the last 3 years, now these have not been the best 3 years in the global technology economy. Accel has had 4 IPOs. They have a cumulative market cap of $5 billion today. I checked. Rich probably knows that number to 4 significant digits. But they've also sold 22 companies for a total of $5 billion in that 3-year period. They've sold 2 to Microsoft, 1 to Cisco, and 1 to Google, and 18 to other leaders in the space. This makes for a really, really good panel, I hope. We'll see how they do. A little bit of background before I introduce each speaker. Tech M&A has been in a downward trend. It actually peaked in terms of value of transactions back in 2006, was down just a little bit in 2007, and fell off a cliff in 2008. And the first part of 2009 was similarly depressed. Big deals went away. There just weren't any. Actually, the total number of deals didn't vary all that much, but what happened was the big deals went away and a lot of small deals happened. Believe it or not, in the first 3 quarters of this year, 1/3 of all tech M&A deals were liquidation sales. It's, small technology rationalization deals. That number used to be like 1 out of 8, 1 out of 6. It was literally 1/3 of all deals in the early part of this year. LBOs became a big deal a few years ago. They got as high as 20% of the deals in technology. Now, that didn't happen at all back 10 years ago, but in the decade of the 2000s, there was free money, and technology looked like a mature bet, and people raised a lot of debt and did a lot of highly levered transactions. Those have fallen away. There are still some that get done. They're much smaller, much less debt, and so forth. However, despite that history of the last 2.5 years, things are looking up. Things have clearly bounced back. Our stock markets have bounced back. All of these people have been announcing deals this year. It looks like the trend is very favorable going into 2010, and we're going to find out more about that this evening. So let me tell you a few things about each of our speakers and each of their companies. A good moderator doesn't read the bio, so I'm not going to do that. I'm going to tell you what's not there. Microsoft. Microsoft should be world famous for having done the best, most profitable M&A transaction in the history of the world. A kid by the name of Gates bought a little business called PC-DOS for something under $100,000 and turned it into a thing called Windows and a company called Microsoft, which is, with $270 billion in market cap, that was a pretty damn good acquisition done several years ago. So if you don't think Microsoft is a good acquirer, take a look at history. Marc, a 9-year veteran of Microsoft, has a very unusual career. He was a banker and then a high school teacher and coach. Then he went to law school and became a lawyer. How crazy is that? And he finally went straight and became a corporate exec and runs the M&A practice for the gorilla in its space, Microsoft. We're delighted to have you here, Marc.
Thank you.
Cisco is widely known in the tech M&A industry as the role model for tech M&A. These guys probably have the highest percentage of revenue contributed by acquisitions over the years of anybody. I guess if you don't count Windows, but maybe even if you do, I'm not sure. They have done it right. They not only have a terrific contribution to their financial statements, they have an unbelievable array of CEOs of acquired companies who are still there. Somebody told me it was 72. I asked Charles if that number was correct, and he said he isn't sure, but something like 72 former CEOs of acquired companies still work at Cisco. And that's impressive. Certainly no other company can make a claim like that. Charles has been there 8 years. He is the digital home guy. He's the reason that Cisco is even thought of in the same sentence as digital home. He did things like Linksys. He did things like Scientific Atlanta. He did things more recently like Pure Digital. He is the reason that they're in the digital home business. And he's the big deal guy. He's also got WebEx on his resume. He's trying to complete this deal in Oslo called Tandberg. This guy is, throwing billions around like they weren't nailed down. So Charles is, he's a role model within the role model. And as all of our corporate panelists will demonstrate, corporate development leaders in these kinds of companies are not just staff guys, gatekeepers, no career before this, no career after this. These are the leaders of the technology industry, and who knows where they'll end up 10 years from now. So stay tuned. Google. David Lawee is perhaps the least prepared guy to be a corporate development exec. He's been there 4 years. The only reason he's there is he was worried that he couldn't get a green card if he didn't take a job there. What was he doing before that? He was an entrepreneur. He actually founded a company. It was a gaming company. He sold it to MTV for $102 million and decided to take a real job in corporate America. That is the kind of company that Google represents. They are a gorilla in their space, but the newcomer, the adolescent, the company that has raised eyebrows with their M&A program. Who thought YouTube at $1.6 billion 3 years ago made any sense at all? Well, the Google shareholders do now, and that's what's going on at Google. We'll also hear more tonight about the recent $750 million deal he just completed with another very early stage company, but one that Rich Wong was very actively invested in. So that's David, and a little bit about his background. He's been a venture capitalist and a consultant, too, of all things. But look what he does now. Accel. Accel is probably the only firm that's not a household name in the room, but Accel is a very well-established venture firm, 27 years old. It's been here in Silicon Valley that whole time, founded way back by Arthur Patterson, who's still active in the firm. That's pretty amazing. And very importantly, not only are they deeply involved in taking companies public and selling companies and therefore appropriate for the panel, they are the most global of our local venture capital firms today. They have very well-established offices in Europe. They have 2 offices in China. They have a newly announced initiative in India. They really believe in global and are out there doing it. So I think that's interesting and can add content for the discussion tonight. So thanks for being here, Rich, and representing the guy on the other side of the table. This room is incredibly quiet, and our job is to fix that. It's going to be an interactive session. We're going to let the speakers talk. I'll throw a few questions at them, but I'm very eager to make sure you get involved, you get a chance to ask your questions. This should be a dialogue with not only the people sitting up in front of you, but all of you in the room who have something you want to find out about. So here's your chance. Let me start. I want each of the three corporate speakers to address this kind of simple question, and we'll start with Marc. So Microsoft has an M&A strategy. You could define it precisely, but you probably don't want to reveal any closely held secrets. But tell us, why is M&A important at Microsoft? What makes it different? Why is Microsoft pursuing a different strategy than perhaps other panelists and other companies in your industry? And what makes it successful? What's working?
Well, first of all, let me say thank you again for everyone attending tonight. I really appreciate everyone coming out. Number one. Number two, as was just mentioned, please make this an interactive session. I think we'll all get the most out of it if we get to hear what you're thinking about as well. To answer the question, the M&A strategy is pretty straightforward at Microsoft. We are a technology buyer. Most of our acquisitions are of earlier stage companies because we have the distribution, we have the sales channel, and we would rather buy early and feed that into the products and processes we have to bring that technology to the widest audience possible. So it's a very straightforward strategy. We think it is successful because we've had some luck in doing it. History shows, besides the one you mentioned, things like PowerPoint was an acquisition, and obviously it's part of the Office suite now. Games companies like the Ensemble, which created Halo, was through an acquisition, and on and on and on. Second thing is, obviously, it's a great source of talent to bring in the company folks who have been, for a period of time, very deeply focused on a particular technology topic is very refreshing when brought inside the Microsoft fold, and using their talents not only for the things that we are buying the acquisition for, but also things that they do after sort of that product gets folded in and the things they go on to do inside the company. So we use it as a source of talent into the company as well.
So even though Microsoft is the oldest, largest, most established of the companies, your M&A strategy is driven toward early stage, new technology buys principally.
Correct.
Yeah, and you've done some pretty amazing things. Charles, let me ask you the same questions. At Cisco, what's important about your strategy? Why does it work?
For Cisco, it's interesting. This is a panel about M&A, but what I would say is M&A is really not the strategy. M&A is a tool. The strategy is really about capturing innovation, and we organize ourselves, corporate development, as a catch-all for how do we capture innovation that sits outside of the four walls of Cisco. We're fortunate enough to have 20,000 plus bright engineers that build things inside of the company and innovate from within, but we're also very much open-minded to the fact that we don't have a monopoly on good ideas. And so we've always been a company that doesn't believe in the not invented here syndrome. And when good ideas happen outside of Cisco, our job is to go figure out how to tap into that. And we've got a toolkit that we can bring to bear against those innovative ideas, and it ranges all the way from early stage venture capital to later stage minority investments through to strategic partnerships. And then the sort of biggest and most impactful headline catching tool is M&A. And so from the very early days of the company, we have used the tool of acquisition as a very important part of our overall innovation cycle, but it's really just one of the tools in the full toolkit of how we make sure we stay on the cutting edge of innovation.
As you stated to me once, it's strategy first, deal second.
Very much the case. I mean, we don't start with the idea of what company we should buy. We start with the idea of what should be our growth strategy and what are the markets that we want to try to lead. And then again, we look holistically at what are the tools that we have from internally developing products and technologies to capturing those from the outside. But it always starts with what's the strategy for success, not what's the transaction to go and execute.
But while that sounds a lot like Marc's comments about buying technology, you have also bought businesses. I mean, you have entered business areas by buying the established leader. I think of WebEx. I think of Scientific Atlanta. You know, there are other examples. That's different. It
is, and really our acquisition strategy or the tool of acquisition as part of the broader strategy has evolved, and our comfort level with the type of acquisition that we can go and execute against has also evolved. I think in the earlier stages of the company, we were more focused on smaller, either product-oriented or technology and talent-oriented acquisition. What's changed really in the last 5-6 years is our comfort level with what we call platform acquisitions. Those are established businesses, hopefully best in class with a particular way of doing things that is appropriate for that market segment. And we have now, over a series of these platform-style acquisitions, shown an ability to use acquisition as a way to bring those platforms into the company and really build around them as an extension to markets that we're already in and as a new market entry opportunity using those platforms.
Okay, great. David, Google, the adolescent company in the panel here, later to the merger and acquisition game, but as I pointed out, raising eyebrows on a fairly regular basis. What's important about the acquisition strategy at Google, and what are you doing to make it successful?
Well, first of all, I guess I'm appreciative that you highlighted how underqualified I am for my job. It's true. I don't know what I'm doing. I also, when you highlighted those numbers, definitely you made me feel like the minnow on the stage.
You don't have the lowest market cap.
We're very, on the other metrics, we're much smaller. I think what's most distinctive, and you've highlighted this in your comments about Google, is just how old the company is. We're just a much younger company, and so we're much earlier in a lot of things in terms of how we're evolving. The way that M&A is kind of the biggest focus of M&A is on the kind of caliber of the leadership that's coming into the team and the execution capacity that they're bringing. And so that could be, kind of through technology leadership, like you'd find in Onto, which is an acquisition that we announced this summer, or it could be in time to market, like Urchin, which became Google Analytics, or it could be opening whole new markets and changing the way people's perspective are around a certain topic area. So Keyhole, which became Google Earth, was an enterprise software company selling licenses to satellite imagery, and obviously had a lot of technology under it and some fantastic technologists. All of those people are leading Google Maps today, and Google Maps has become, kind of obviously a lot more with Street View and with wiki aspects to it. We're obviously have built a lot under these people, and they're vice presidents. There's not that many vice presidents at Google, both Brian McClendon, John Hankey. These are the leaders of our business. So they added, and now I think when you actually think about it, looking at local data without the context of a map actually seems completely anachronistic. So we've really, through that acquisition, changed the way people perceive and expect to see local data. And so it was really just a capacity and a way of viewing things that has completely changed as a result of acquisition. So they're having, I would characterize it in the exact same way in that it's not a strategy, it's kind of a tactic. and that it's, kind of, we would love to have the track record of 72 CEOs kind of ultimately kind of still working at Google, and we're working towards that. The numbers are excellent in terms of the retention rates of the people that were, kind of are joining Google through acquisition.
It gets easier with a stock price at 600, doesn't it?
The people that are motivated by stock price aren't the people that we're going to be successful retaining. The people that we're going to be most successful with are people who have a big vision for what they want to achieve, a strong personality, because Google it's like landing in China. You could be a great entrepreneur in the U.S., but you still need to learn the language. You need to figure out how things work. You need to figure out how to get resources, how to execute. That's what Google's like. And so great entrepreneurs can come in and figure it out, and they end up succeeding. And then, and so for the most part, it's been really successful for us. And those people are people who have the vision, not the people who are, they're going to make money, obviously, but they're usually about something bigger.
Very interesting point. I hope everybody heard that one. Rich, let me ask you to describe your experiences on the other side of the table. You've dealt with gorillas like this. You've been involved on the boards of companies that are talking to other buyers. What distinguishes, from your point of view, the really good buyer from those that are not so easy to deal with?
Well, if I may say, so first of all, I've only had really one experience, and it was with David in the AdMob scenario that occurred. It was announced at least a few weeks ago.
So Rich loves me.
I do, very much so. I agree with everything David says this evening. Prior to that, I actually was on the other side of the table, on the corporate side, looking at business units and such. So I'd say, I think what we tried to do when I was on that side of the table, and what we really appreciate from certainly the people at this stage and others that we work with, is frankly the professionalism that different people show in their process. I think what is really distracting to a startup company, and there's only so many people working at a startup company. Obviously, when you have an M&A process, you have to involve the CEO and the top management of the company, and it's very distracting. And so I think one of the things we appreciate most is people that are professional enough to give a fast no. That if they kick the tires, maybe the corp dev team has a view of it, but the business unit that's got to bless it doesn't quite get there. That they don't drag it out around 3 to 4 to 6 to 9 month process that can really be damaging to a startup company. So I think we really appreciate people that behave in a very professional way, and we certainly appreciate that from all the people that are here. Secondly, I think there are certain organizations that sometimes you sort of wonder if there's sort of competitive G2 is at work in the conversation. Are they trying to learn about the space? Are they genuinely pursuing an interest in the company? And of course, like every relationship, it doesn't always go all the way, and there are a lot of reasons why deals don't come together. But I think over the course of time, you get the sense of, again, which companies, which corp dev teams, sort of treat teams with respect. And when the information goes to the corp dev team, it doesn't end up making its way back to the BU that might be the competitive BU in the space. And so I think those are the things that we look for. And I think that's why we do try to build relationships with the principals like these three guys. And that's why if I wasn't sitting here, I'd be sitting there listening to this panel tonight. So thanks for letting me be here.
Have you faced the problem where a well-qualified buyer is simply too nice to say no thanks? Have you been involved in situations where the big company strings along the small company?
Yeah, I guess the short answer is yes. I think it does happen. I think in large organizations that are, many of us have worked in these or maybe work in them now, that are multifunctional and multi-business unit, and the corporate head doesn't always talk to the BU leader, or the VP of sales has to take on the new quota for the product that's being brought in. Sometimes you can get down the road and it turns out that people are too uncomfortable to say we're just done, we're not interested anymore. And so I think to some degree, whether it's a banker or a venture capitalist who's been through the process a couple of times, you sort of probably know who to call in the organization to say, hey, where are we? If we're really going to get there, then great, we'll continue the process. But if we're not, let's call it a day and we'll try to go back to work. So I think that is some of the value, certainly speaking for the two of us on the ends here, that maybe a banker or a VC might.
Good point. Well, and I think the really capable buyers, like the three corporate representatives here, they're good at saying no. If you can't get support in your organization, you're not going to string somebody Wong. Let me come back and ask what's going to change over the next 2 or 3 years in your M&A programs. I mean, Marc, will Microsoft do the big blockbuster deal? You know,
We tried already.
It gets itself in the newspaper every now and then for chasing these things. Is that likely or not?
Well, one can never say never. I wouldn't have thought, 2 years before, if I had been sitting here and you asked the same question, would we have made a bid for Yahoo? Who knows? What I can tell you is, though, as much as Charles said before, we're thinking about it constantly, about build versus buy. We're thinking about new markets to enter, how we're going to enter them, whether it is through acquisition, whether we're going to do it internally or not. Most of the time we default to an internal process, and part of that is Microsoft culture, part of that is Microsoft hubris. But I think there is a belief that because we have a platform company, knowledge of the platform gives you unique ability to build things that are hopefully more ready for customers faster than you can just by buying something on the outside and trying to rejigger it and put it on top of your platform. So with that backdrop, I don't have any news to break. But I will say you should think of us as being involved in a lot of conversations, as I'm sure all of us are. We are constantly looking with our shareholders' interests in mind about what we can do to continue the growth of Microsoft. And if that's a small transaction, that's where we'll be. If it ends up being another large transaction, we'll pursue it with vigor.
And you've got significant-sized businesses in multiple markets. Are you likely to really focus on 2 or 3 of those, or do you think you'll do deals in essentially all of your markets?
We certainly look across the board, but you can imagine the priorities of Microsoft end up being the priorities of the M&A, because you're more likely to be thinking about how you're going to be able to either grow a certain segment if that's a priority, or how you're going to react to a competitive threat. Search, for example. We spend a lot of time thinking about search, thinking about a very formidable competitor that we have in Google in those spaces, in and around those spaces, and what are we going to do? And we've done a string of acquisitions from a Quantive and a lot of smaller ones you probably have never heard of in an attempt to, again, further compete. Part of the Yahoo strategy was about that, bringing those two companies together. We ended up doing a partnership which got, we think, both of us great benefits, and much of what we wanted out of the larger transaction, we think we're going to be able to work through this partnership when it gets started. But coming full circle, I think the important thing is we don't think about it as M&A is the lead dog. We actually think about, as has been said multiple times here, it's the strategy that will guide us, and ultimately, if it's M&A. Around the company, we talk a lot about virtualization. We talk about cloud computing. So it really is across the portfolio.
Interesting. Let's see what you have to say about that, Charles. Is Cisco's M&A strategy or process going to be different in the next couple of years?
Well, I don't think it's going to be fundamentally different. I mean, the reality is Cisco's coming up on our 25th anniversary as a company, and from the very early days of the company, M&A has been sort of part of the DNA of what's made Cisco today. And so that fundamental belief that capturing innovation from all corners of the industry is part of what we're trying to do, that's consistent. I think what's evolved and what continues to evolve and will change going forward is just the breadth of the business that we're taking forward, the breadth of industries and geographies that we're attempting to lead in, and by default then the breadth of M&A activities that we will put against that. If you just look in the last few months, we've been quite busy, and it's been global and spread in lots of different segments of the industry, whether it be something like a Tandberg, with primary operations in Europe and a focus on video communications, to a Starent, in the U.S. with a focus on service provider, mobile edge, and equipment, or a DVN, which is a China-based set-top box play. different geographies, different markets, all happening simultaneous in the way that we're executing. And so I think that complexity and the breadth of our business will be followed through by increased complexity and breadth in our M&A activities. And so we have built and continue to build a process and a capability and a team that's ready to take that on. But I expect that will increase as we go forward, not decrease.
Incredibly broad. And there's a lot of fog on the Cisco mirror about smart grid and how important that's going to be. Might we expect to see smart grid-related acquisitions?
Well, I think smart grid is one of 30-plus market adjacencies that we have identified. And the thing about Cisco, people often ask, well, where are you focusing your energy on M&A? And we're the most transparent company you can find, which is we have a list on our homepage that says, here's the 30 markets that we're going after. Every single one of those markets, we're thinking about, as we've said, the holistic opportunity for innovation, internal, external, a combination of the two. And so you shouldn't be surprised if you see us acquire in any one of those 30 identified market adjacencies. Smart grid is one of them, but again, it's no different than any of the others in the way that we'll attack it holistically and how we can be successful in that market.
So, David, is Google going to put their list on the website?
I don't think so. I think it's interesting. Maybe we would if it was a good idea. I think that like if we thought it was going to work, I guess. The thing is that we're less established. So we're learning from these guys. I think you characterized it correctly. Cisco is definitely admired within Google as one of the best tech M&A companies.
And
ever.
within Microsoft as well.
Yeah,
Absolutely.
and so kind of the way that they're thinking about it, is certainly something that we think about. I think that we're younger, and so we're, like a kind of a 11-year-old child. You want to test all this.
Frivolous? Is that the word?
No, you want to test the boundaries of what you're doing to make sure that you're really innovating in every function that you have. So our HR group is innovating. Our our real estate group is innovating, and they really are. Like the HR, the idea of having stock options that are tradable was a real innovation. The idea of having real estate, kind of really think about kind of creating a homogeneous environment across the world. So people walk into any Google office, you swipe your badge, you feel at home, you go to the cafeteria. Like they're innovating. And certainly on the M&A front, we are innovating in terms of how we think about deals, in terms of where we're, trying to lean in. And the founders are definitely a big part of that process. I think the only other thing to mention is, kind of to your original question, is that the landscape is just changing at lightning speed. And the undercurrents of the industry, large discontinuities, such as mobile, which is staggering. We've all been waiting for mobile, but now with the smartphone market, it's just a staggering discontinuity to everything that Google does. The cloud space, which is maturing, the degree to which people are prepared to share confidential, or what you would have thought are confidential, but private information or information about themselves on the web is changing. So the number of changes just leads me to believe that this is going to be a very active environment for entrepreneurship and a very active environment for companies, larger companies, to use every tool they have to try and stay competitive.
So, Rich, looking forward with your portfolio and your colleagues at Accel and other venture capitalists, we've had a recovery in the stock market over the last several months. There is a glimmer of hope that an IPO market will return to technology. A few companies are getting out, and several more are in the pipeline. Is your view toward the M&A exit going to change? Is your value equation going to be different if we have a healthy stock market? What might change from the vantage point of an investor?
So yeah, just maybe to set up a few backdrop points. I think the environment is improving. I think thank you for speaking about some of these exits. And if I just highlight a couple of them, I think what's interesting is that they're in very diverse categories in this last 120 days. So BBN, a defense contractor, sold to Raytheon Zoopit sold to Yahoo, Web2 email, SpringSource sold to VMware, Playfish sold to EA, and then, of course, AdMob, Google. And so they're all totally different spaces. And so I hope that's encouraging for, hopefully across that span of those 5 different companies, almost all of us in the room work in one of those categories. They're pretty up and down the stack when you think about it. So I do think, both the M&A environment is, I think, there's definitely more activity. Now we'll sort of see how much of these dates, go all the way to a full relationship, as it were. Now, the IPO market, it's hard to judge. I guess there's many public market folks, like yourselves or in this room, they're going to have a better view of exactly what the public capital markets are going to do. There certainly are more registrations. There's more S1s, and there's certainly slightly more activity in 2009 than in 2008. But 2008 was pretty ugly, as all of us know, so it's sort of a very much a low bar. Look, as I sort of jokingly might say, none of us here on this panel and probably in this room are communists, right? So if you believe in the capitalistic system, there is a market price, and obviously our job for our investors and implicit shareholders that own the pieces of these startup companies is to get the best price and also have it be the right fit for the team, so it's not a horrible outcome after the companies come together. So with those 2 goals in mind, it is of course our goal that if there are more options, there's a market clearing price for that hopefully valuable company. The one other just quick comment I might make to the back end of that, though, is there's a bit of discussion, and sometimes we think about, where's Charles or David, or where are these great companies going to go next in their space? And we're almost always wrong on the estimates of the timing or the vectors. And we're just, we have a chance to talk to a lot of these guys and talk to the other executives and the business unit leaders and alumni that just leave these companies, and we're almost always slightly off in terms of our predictions. And so I think there is an ethic, if I may just say, that you still have to sort of build your company to be a business and build your company for the innovation that you really want to create. And the promoters or the schemers, as I call it, that you often sometimes see, and some of them succeed, some of them pull it off. But they're saying, I'm going to build this to sell it to Google in 3 years. It just doesn't tend to work out that way. So it's great to be able to think about it, but at the end of the day, you sort of have to go back and do your day job of building the company. I think ultimately that's what guys like you guys will respect and hopefully pay money for. is our view.
Yeah, to the 3 corporate guys, you've looked at lots of companies, many of which are venture capital backed. Do the venture capital backers help or hurt the process of making a deal?
As in most things in life, it depends. It really does, and there can be hundreds of reasons why. I do think the best relationships are actually born, and it's true for the company as well as for the VC backers, if you know the people in advance. If you've either worked with them in a business development context between the company and Microsoft, we have a lot of programs to try to foster that, to get people onto Microsoft platforms, or at least expose them to the Microsoft platform, to really begin the relationship, which makes it much easier down the road. And I think the same thing is true for bankers as it is for venture capitalists. If I can call Rich on the phone and have a conversation about something, the process itself tends to go much smoother. If it's someone who I don't know, it has a tendency to be less smooth.
But don't they always ask for too much money?
Yeah, but we don't give them. It's very clear. I mean, just as he said, he's trying to maximize price. We have a price at which we just have to say no, and we have shareholders as well, and we're there to protect them and their interests. And I have no problem. In fact, I've got so many things to do. It's better, as Rich said, if there's a fast no, and let's both move on and do something else. So I think that's a win, actually, for everybody, if that's the ultimate answer.
Charles, David?
I think we, as a company that's been as acquisitive, we bought all kinds of different backgrounds to companies, venture-backed, not venture-backed, all things in between. And I would say there are goods and bads. We've bought companies that have actually gotten to some substantial size that haven't had venture capital backing. Linksys is a good example of that. That was a husband and wife team that, blood, sweat, and tears, and a decade of really hard work, built a $500 million business. And it's a fantastic, American dream kind of story that everybody would aspire to be able to pull off. And as an acquirer, that's great. I mean, our focus is we want to deal with the principles of the business. As nice a guy as Rich is, when the deal's done, he isn't coming to work at Cisco. And so the principals of the business are the people that we're building long-term relationships with, so that hopefully the dozens of CEOs there at Cisco, we grow that number because we've built a trusted relationship. Having said that, great VCs, and Accel is certainly one of the best firms in the industry, they had a tremendous amount of value in actually rounding out a company. And so when you buy a founder-backed business that has never had outside capital, things live in shoeboxes and processes don't exist, and maybe there isn't a board, and they don't have audited financials, and they haven't thought about how to actually forecast. All those things that VCs actually require in terms of discipline in a business, that's real value. And so we certainly are very comfortable with great venture-backed businesses and all the positives that VCs add to the equation. And so they're just trade-offs depending on the outcome.
David, anything you want to add?
Well, I can only think of one transaction in the kind of hundreds that we've contemplated where the VCs have not been a positive or have been negative. So I would say our experience is 99% of the time, really greater than 99% of the time, they're a huge asset. They're experienced. They've done this before. Kind of a lot of times the entrepreneurs haven't. There aren't that many entrepreneurs that have sold multiple companies. And you're doing one of, it's the biggest transaction of your life. And you're listening to all kinds of people. And it's good to have people who have done it before. And so for the most part, like the vast, vast majority of occasions, we're finding that those are our allies in terms of helping to describe kind of what we think the right way of kind of navigating through the process. Because you don't want to share too much information early on, and the VCs can help you navigate that. There's just so many parts to the process of kind of the discovery of whether it makes sense. And having people who are experienced, there's just really no replacement for that.
If I could just add a point, because this will sound a little odd coming from me, I suppose, but I don't mean to be disloyal to my own kind, as it were, but I think it depends is very true, by the way, on many aspects of venture capital. I would simply say there's nothing worse than an out of context venture capitalist who's doesn't know what he's doing in the particular industry, and more importantly, doesn't know where they are on the playing field. Right? It's sort of, we think the company that perhaps might not fund a company when things are going poorly, but then all of a sudden, once there's a small hint of interest, suddenly thinks that they're the next YouTube, right? So we're not selling it for X, and all of you that have been in these transactions know that this exists. So I think I'd simply say that the so what for it, if you're an entrepreneur, is diligence your VC carefully, whoever it is, me, Accel, other great VCs, Sequoia, Benchmark, they're great firms too. But whoever it is you're going to work with, you're going to be working with them for a while if it works. So check them out and make sure you really like them and you think that their work ethic and their focus is worth it. Because we do as well when we think about syndicate partners. And because we also want to be in a situation where everyone's sort of pulling at the wagon the same way and not, in different directions. So it really does depend, actually.
Yeah, thanks for that, Rich, because I'm afraid the three corporate guys don't want to offend any VCs or prevent getting the call on the next interesting deal, but there clearly are venture groups that have stifled the acquisitions of their companies, and maybe you just haven't had to.
Well, for a while, there was a perception, I think, and maybe exists in some parts. There was a fear of dealing with Microsoft, and we've worked really hard to try to overcome that. And it was both in the entrepreneurial community and in the venture community, and we've worked really hard to try to show that. Whatever one story has been made legend, isn't who we are.
That's the peril of being the long-established guy, I suppose. And the rumor mill has more in it for a guy that's been around for 30 years than somebody that's been around for 10. That's true. One last thing I wanted to touch on here before we open this up to the audience is the global aspect of the technology business and what that's going to do for each of you looking forward into the next 2, 3, 4, 5 years. That $100 billion in cash is actually a majority of it is sitting offshore. I'm not sure how true that is at Google, but I know it's true at both Microsoft and Cisco. To what extent is the global acquisition program going to get a bigger share of mind, a bigger share of deal value? Charles, you want to start?
We're living it. So for those that follow Cisco, it's it's already in the rearview mirror. I mean, the last few months, we announced the Tamberg acquisition, our first public company transaction in Europe. Followed that up within a couple of weeks with our first acquisition in China in DVN. We have already, over the last few years, in terms of our venture, our own investment activities around venture capital, or as I said, we've got a very active $1.5 billion portfolio of our own minority investments. More than half of that is outside of the U.S. So we are a global business, and as we continue to grow our activities in places outside of the U.S., our M&A and investing activities will follow suit. So we very much believe that if you look forward the next few years, the percentage of our M&A activity that is outside of the U.S. will certainly be higher than it's been in the past years. But again, we're living it even in the past few weeks.
True for you, Marc?
Yeah, I would agree. The only disconnect, I think, between your question and the answer that I would also agree with is it isn't because there's captive cash that's driving us to do M&A outside of the U.S. As has been mentioned several times here, it's the strategy that drives, and M&A is just a tool to execute on that strategy.
Growth markets and
Absolutely
emerging
right.
technology. And
Absolutely right. And so China, we spend a lot of time in China trying to understand the landscape and trying to predict where things are going across our entire portfolio of products, and trying to determine whether that technology is compatible with the other things we do in the rest of the world. Do you take a different approach in China than you might in other markets, et cetera?
David, what about Google?
Yeah, no, the
You're
answer
there
has
too.
covered us. Yeah, I mean, we're not making decisions as a result of where our cash is.
But will you do more globally, you think?
Inevitably,
Uh-huh.
yeah.
Starting now?
Well, I just think that there's nothing to prevent us from being as aggressive internationally. There are great people all over the place. That's kind of been our strategy in terms of putting engineering centers in as many countries as we have. I think we have 60 offices globally. Our mindset is, kind of 1,000 points of light. That's a really hard strategy to execute on because you have teams working across time zones. But it's the strategy that we're employing. And so we have a footprint already of engineers around the world. And so we have, kind of the capacity to add to those centers via acquisition in a relatively seamless way, at least if, compared to if we didn't have those offices. So it's certainly something that we can do.
Okay, great. Let's see if we can open this up and get some questions coming from the audience. I suppose the position of the microphone determines the sequence of the questions. I don't have control over that, so who's got a mic here? We'll start here.
Okay, Larry Ellison. I'd be interested in your reaction to the planned acquisition of Sun Micro. Maybe to focus your comments, do you think the Europeans should approve it? Do you think they will approve it? And if they do, what do you see as the impact on your business if the acquisition is successful?
Who are you directing that at?
All three.
All three?
Well, we'll let Rich go first then. Hear what he has to
Well,
say.
while you think about a good answer.
How to duck it.
I would say ask Oracle is the right answer to that question. I mean, I think everybody's got their own twists and turns to their M&A activities, and so Oracle's going through their process, and I think it'll be interesting to see how the government responds when this thing's all said and done. But they're the ones to answer that question.
Well, Microsoft has certainly had some direct experience with the EU and their competitive
And ongoing.
commissions.
Ongoing.
Do you think it'll get done?
No comment on. I'd echo what Charles just said.
I think it'll get done, but that's just me, uneducated. But well, that's not true. I've got a lot of EU scar tissue too from 30 years ago. Okay, so we don't know the answer to that since we're not Oracle. Who's got the mic? Do we have it over here?
Yeah, I'm Kelly Porter. Great. I'm Kelly Porter from Woodside Capital Partners. We're a boutique investment bank here in the Valley. And I want to ask you guys about, this is a competitive marketplace. You probably see a lot of the same deals that other companies are seeing. how is it, when you look around at, say, the top 30, top 50 technology companies, who do you admire? Who do you respect? Who do you think is really doing it right?
From an M&A
Current
perspective?
panelists, not,
From an M&A.
but you can't just pick one of these guys. That's too easy.
It really is. And this isn't a joke. We're friends, but it is really Cisco. The pace.
Come on.
It's true. I can't lie.
Yeah, I agree. It's true.
It is true.
Who else?
Who else?
Who's your second?
I'll take that, and I appreciate people say nice things about Cisco. I think there are lots of things to admire about all of these companies. Nobody in the industry wouldn't have liked to have been at Google the last few years. I think on the M&A front, actually Oracle. So I can't answer about what's going to happen with them in the EU. I can't talk about as a third party, what we have observed with their M&A strategy. And it's very interesting because it's been a very active M&A strategy and a very different one from what Cisco has taken forward. And I think for the most part, what all the companies on the stage have taken forward. And M&A is a tool to achieve a lot of things. And from an outsider's perspective, I think Oracle has done a really good job of using it as a consolidation tool, where they've aggressively gone into categories and used M&A as a way to bring share together and take competitors under the fold. And that's not something that's been part of our historical mandate. It's something we're not really equipped and comfortable to do. But if I think holistically about you want to be able to apply the tool to all the outcomes possible, I do look at Oracle and admire what they've been able to accomplish.
Well, I'd one just, I think, somebody to watch, which is very interesting given where we are location-wise. Adobe, I think, is an interesting company to watch. Now, I would say their process is nowhere close to as disciplined as these guys, and they're newer to the approach, but it's been fairly visible what they've been doing recently, and I think it was a major symbolic or signal of Shantanu, the CEO, who's now there. I think has set a course for how he wants to transform Adobe from what it has been historically, and it's been very successful when you sort of look at the income performance of the business. So I think that's an interesting company in the area that often gets missed among the big boys, as it were, around the valley. But I think will be an interesting one.
What do you
Certainly,
guys?
as venture capitalists are thinking about, what else are they going to do next?
This might not be fair. I'm sure we have some employees in the audience, but what do you think about HP and how their M&A strategy seems to be taking shape, becoming more important, and so on? Are they likely to be extremely successful going forward with M&A or not? Any thoughts on that?
It's really
Come
so hard
on.
to tell, though. I mean, how can you tell if you're not working in those companies? Like I could say, as an entrepreneur, there were very few companies that I thought treated me respectfully, responded coherently. Like I would get one answer from one person and one answer from another person, and a lot of this happened in the late 90s when things were frenetic, but I felt kind of bloodied by the process repeatedly. And certainly when I think about the characteristics of kind of what we're trying to do at Google, because we're really just laying down the foundation and building the culture kind of now, it is kind of being that cohesive and consistent and responsive and saying no and answering all your emails and building the relationships so that people know how to navigate the company. Yeah. We can't control everything because you're talking to people all over the place, but we try and do the best we can when you call us, and it's hard to manage your inbox when you say that because then you get kind of 700-800 emails a day, but you try. And I don't know. I don't know. I would feel very uncomfortable commenting about kind of the success of some other company's M&A strategy. I feel very good about what we're doing.
Mm-hmm.
And it's really hard to answer that question.
The only thing I would add is I think, I'll look to you guys to see if you agree, our approach is over a decade or longer. And so the things we buy today, I don't even know if we think they will, but we don't know if they'll really pan out for several years to come. And I would assume HP it's much the same way. They've transformed their business over the last couple of years, EDS and other things they've done. Whether it works or pays off, I think is actually a much longer term. You won't be able to really answer that question for a long time.
I think, as I was saying before, some things are not about good or bad people. They're just the way the organization is structured sometimes, right? And,
yep.
As many of us know, I've spent time at HP as an employee. it's an organization that's very business unit centric historically, so that the local GM has a lot of power. So as a result, you have to sort of talk to a lot of people. If there's by definition, most of these interesting companies sort of span business units and span organizations. You got to talk to someone in Boise and Fort Collins, and it's just hard sometimes to navigate the organization. I think the fact that these three gentlemen here is sort of a public face you can reach out to. HP is a little more amorphous, and I don't think it's because of bad people. It's just harder to figure out.
You do
who
have to give them
sometimes.
credit for making their big deals work. I mean,
Yeah.
they've probably done the toughest integration jobs that anybody has tackled and have made it work.
And it's a related compliment to the Oracle comment before, right? Which is some of the deals Oracle's doing or HP's doing aren't the sexiest things in the world, but a real income statement, cash flow, cost management, and that's really hard stuff to do. It's so yeah, I agree. I happen to agree with that statement.
Okay, who's got it? Right here.
Glenn Toby, as somebody who's bumbled through integrations, you hear buying companies is fun and integrating is hell. And
It is.
as one of the people who's been in the room where you have a Goldman Sachs person and you have a McKinsey partner talking about strategy and operational fit, you see The Economist come back, Economist Magazine comes back and says, you know what? In The Economist, the culture is the critical secret sauce. Again and again. So how do you have time to honestly scan what you're buying and what is the process you use to get your hands around what are we really getting into when we're dealing a lot with the human capital equation, not a strategic and not an operational?
I mean, I think you hit it exactly right. That is the hardest part of the job. I think when a set of executives meets with, kind of a large number of people inside a company, like just speaking of Google, like if you have an executive like Omar and he does the rounds and he meets with 15 people who are senior executives at Google, you get a pretty good feel. It's like the interview process in a sense, triangulation, but people felt great about Omar. Like Larry and Sergey feel great about Omar. Eric feels great about Omar. Kind of Susan Wojcicki, Vic Gondodra, like all the leaders of the business, kind of that interacted with him over the course of, kind of what was a relatively short period of time, loved him. And so when you get that strong degree of resonance, you have a lot higher, conviction. And then in this case, it happened that I had been, keeping up a relationship with Omar for almost 2 years. So I had, kind of been having breakfast with him and been getting to know him just because I thought he was just a phenomenal entrepreneur. And so, you aggregate all the data points that you have and you make the best decision with the information you have.
Charles, you have done some really big, really old line companies. In fact, you're working on one now with Tandberg, Scientific Atlanta. Your comments about this cultural fit and how you measure it and how tough it is to integrate would be useful, I think.
Yeah, so I think the question's right on. I mean, integration is the hardest part of the overall process. But I would also say that integration doesn't fix the problem of buying the wrong company. So it starts with if you buy the right company, integration's even more in focus because the only thing they can do is screw it up. And if you buy the wrong company, they don't have the magic potion to fix a mistake that was made up front. So it's a really tough place to be because you take on all the burden of the hard work and most of the time don't get the credit for all the good things that you've done. It does, though, start with culture and fit. And it starts with culture and fit, I think, beyond the CEO, and that's a very important part of how we look at things. As great a track record as had of keeping CEOs of acquired companies, it's one individual. And if that individual makes a decision to leave or for whatever reason isn't a fit, you got to make sure that the rest of the culture of the company is something that will play well with inside of Cisco. And so we've learned a lot over the years about what culture means. Culture doesn't mean that it's a Silicon Valley company that does things in the way that we do here in San Jose. Our process that we've just gone through in getting to announce the Tandberg transaction, you start with the point of view sitting here in the valley that, boy, Oslo, Norway is really far away, and they must do things really different over there. And then you go and you meet people, and you sit in a room, and you get to know individuals, and it's a great culture at Tandberg, hard driving, aggressive, and all of a sudden you say, boy, it's really far away, but it kind of feels a lot like the way we do things at Cisco. And over that get-to-know-you period, you get a feeling that at multiple levels of the company, all the way down to the very low levels of the company, it'll work. You can kind of make it happen, and there will be a relationship that can fit for the long term. So it starts with sort of cultural alignment, and then from there it goes into all the hard work of operational execution that integration has to take on.
I might just add one thing to say. I don't know how many of you guys have read the book Blink, right? The Malcolm Gladwell book. I think that's actually, I'm not saying I'm any good at it, but I sort of try to imagine that for a second sometimes. And, venture capitalists, you're sort of seeing lots of companies, and you're seeing people stroll through, and sometimes people are promoters, schemers, real technologists, people that are great technologists but can articulate their idea. And so you try to figure out how to very quickly, generally within 60 minutes, try to figure out if you're going to take a second meeting or not. And it's a related process, I think, to the guys that, other guys that, the M&A jobs on the table around the panel here. I guess something I'd say is you can generally tell, is my opinion, whether someone's an authentic person relatively quickly, right? You don't know how smart they are, or, their sales forecasts and, their, COGS management and all the other things that you could eventually have to figure out. But you sort of figure out if you can kind of trust them, if they're sort of an authentic person. I'm personally trying to see if I can do a better job at that in my profession, because it's actually pretty important to what I do. And I think that's one thing at least a lot of us try to do, is it a good person? And that I think can be done relatively quickly, actually.
Good question. Who's got the mic? Is there one back there? All right.
Hi, my name is Vince Stochev. Just two quick questions. So we've seen two acquisitions recently that point to two very different strategies. One is Dell acquiring Perot Systems, and the other one is Sun being acquired by Oracle. So Dell is trying to become like an IBM and more of a service integrator, while Oracle is going more for the technical level consolidation. Which one of these strategies do you see is more viable going forward? And the second part of the question is, you've all mentioned the cloud and cloud computing. Going forward, do you think that cloud enablers are going to be more interesting targets, like a Rackspace or a Red Hat, or companies that already have their own cloud strategies that are like success factors, like tell us something along those lines? Thank you.
Two questions.
Well, I think it's difficult to talk about the M&A strategies of other folks. I will say from Microsoft's perspective, the services component is about partners. We have a small Microsoft consulting group that works directly with customers. But our strategy is a partner strategy in that on that dimension. We will continue in other areas to buy companies, look to build whatever the right entry strategy is outside of services. So when you talk about technology broadly, that's what we do, and we'll continue to do that. On the second question about the Rackspace, Red Hat, and other folks, all interesting companies. Everyone, I think one of our visions, we talk about 3 screens in a cloud. The cloud is there for a reason. We're going to spend a lot of resources. Starting in February, Microsoft Azure will go live in 41 countries. It is our effort in the cloud space. We think that's very exciting. We know that others who currently are, and then there are a bunch of people who want to play in that space, and it will be an interesting 5 or 10 or 15 years as people mature through that, whether it's Red Hat or Rackable or a bunch of other people. I don't know.
It occurs to me that your question about Dell, your question about Oracle, those are very mature businesses that are doing different things than just buying the technologies that are going to be needed to build out the platforms. I think those are probably more financially driven kinds of deals than fundamental technology deals. There are clearly technology involved, at least in the Oracle Sun thing, but just different kinds of deals. And obviously cloud computing is getting a lot of attention, and there will be deals that are done with an eye toward being an effective supplier in the cloud. Who knows what they're going to be, right? Next question.
First of all, thank you for being here tonight. My name is Chuck Bajaj. I'm over at SOA Projects. All of your companies have grown historically through acquisitions. This year has been a year of flux. What is your outlook now for 2010? Are you going to see more mergers or are we going to see more acquisitions? And why do you feel that it's going to be one or the other for the upcoming year?
I mean, I'm happy to take a crack at that. I mean, I think we talked a little bit earlier about how at Cisco our acquisition activity is evolving, but just in sort of general pace, we're very much a believer that you acquire companies of smaller size, sort of small to medium, and you look at partnerships and other ways to work hand in hand with companies of similar size. So we don't have any expectations that basic fundamental approach of what works and doesn't work in M&A will change at Cisco. So mergers, quote unquote, where you can consider companies of equal size coming together, not something that in general I think has been proven to be successful in the industry, and is certainly not something that at Cisco we have any expectations of changing in our view. In terms of overall activity, I do think that it'll be interesting to see in 2010 whether the pace in the last few months continues. It's been interesting both on the public markets IPO side as well as on the M&A side. The nuclear winter of sort of the first half of 2009 didn't mean people stopped going to work. And so there were a lot of people still thinking about what they should do and just waiting to see when the time was right to do it. And so certainly at Cisco, part of the reason we've been active over the last few months, it's not because these are ideas that we just came up with in the last few months. It's because they are ideas we were thinking about for a while, and then when we felt like we had stable footing underneath us, we went into execution mode. And I think that's true for a number of players in the industry, and it's true for the public IPO process, and that there were a lot of good companies that just couldn't get out into the public markets. And I think it'll be interesting to see in 2010, now that sort of the initial pipeline has cleared both on the IPO process and on the M&A process, whether the activity of the last few months will continue. We certainly have an expectation to stay aggressive, but I think for the industry at large, it'll be interesting to see whether that pace picks up.
Yeah, one good comment that I would like to add is the measurement of kind of impact. I think it's very easy to gravitate towards the big dollar deals as kind of being the most important. But when I reflect on the deals that Google's done, kind of Android, Keyhole, Urchin, those were seminal deals in terms of the repositioning of, or the kind of extension of what Google was doing. So Android obviously has had a huge impact in terms of our tactics in the mobile space. And then I talked about Keyhole and how we kind of have changed. We really was our first step out from pure search to then have the Maps product, which was obviously a big change. And the impact of the Urchin acquisition and Google Analytics has really facilitated our advertisers understanding a lot more about the return they're getting on their advertising, and the penetration has been phenomenal amongst our advertisers, or the take-up. So those are all deals that you wouldn't know the number about because they're kind of relatively small in size, but they have a huge impact. And I would suspect we would continue to be just as aggressive, in terms of the number of those things that we do.
Next.
Hi. Throughout everything here, it's been mostly corporate. Do you ever see kind of the same kind of aggressiveness with building up kind of like these kind of for-profit things with, let's say, a nonprofit, is there some way, let's say, a nonprofit can use some of the techniques of a merger and acquisition to kind of build up their strength, so it's not just a bunch of individual companies, let's say, doing the same thing, but maybe achieving a greater goal? I was wondering if you guys had any kind of thoughts or ideas, maybe if anything that you've done in your work or as a venture capitalist can kind of build up and maybe be a more...
I think maybe one example might be industry standard groups. Me and this gentleman sort of in the back row here worked on this thing called the Messaging Anti-Abuse Working Group, which is sort of this very long, poorly named thing that was sort of dealing with anti-spam and antivirus issues in the service provider space. And it was initially actually so we could sell much technology to all these service providers was the original strategy, but it turned into a real organization to our surprise. And it's where a lot of the Bell South, Comcast, Cox, a bunch of people got together to talk about these issues. And there were these other working groups, like the anti-phishing working group, and these other groups were like, wait a second, if these guys really get progress, the service providers will start going to those meetings as opposed to our sort of standards working group meetings. So we ended up finding a way to co-opt them and sort of stick them into the hole. And so, to my surprise, I must say, this thing called MOG still exists. It's still a recurring twice a year meeting for people that care about security technology And it didn't start out that way, but it was by subsuming and co-opting others that had sort of adjacencies. So that's one example.
Yeah, I don't think we want to spend a lot of time on the nonprofit world tonight. That wasn't our purpose, but it strikes me that the softer aspects of successful merger and acquisition transactions definitely apply to any kind of organization. The financials will be very different, of course, in a nonprofit world, but the cultural integration issues and so forth are, there are lots of lessons to be learned and transferred to any kind of organization. Next.
Hi, Rob Fernandez, Wells Fargo Bank, also a fairly large acquirer as of late. There are very few companies of the size represented on the panel and the ability to acquire the scale and the purchasing power that you have. Do you oftentimes find yourself in competitive bidding environments, or more often are you the only really viable acquirer that's sitting at the table?
Good question.
We do see ourselves in competitive situations. We don't particularly like them. That's why we try to spend a lot of time cultivating relationships so that the companies can make, in some senses, a decision before they come to that point in their life cycle about what is the better cultural fit, what is the better place for us in terms of vision, in terms of values, where do we think our product could actually reach the biggest audience, et cetera. And so we try to spend a lot of time getting our word out so that people can make those decisions earlier on. Competitive situations happen, and we try to compete up to a point where we think the value exists, but after that, we're willing to walk away, and I think that's part of my job is to not get deal fever, even though I love transactions and I love to get deals done.
Yeah, I mean, for us, I think there's sort of the best case process, and then there's the reality of other things that occur. So the best case process is you get to know a company, you take your time, there's no rush on it. That sort of naturally develops into a point of view that they want to be part of Cisco, we want them to be part of Cisco, and then you get into an acquisition conversation and you buy the company and no one else ever shows up in that process. And that definitely occurs. It occurs a fair amount, and when we are doing our job the right way, they are so focused on wanting to be part of Cisco for all the right reasons that, generally we can control that without it being competitive. But, nobody lives in a perfect world, so there are certainly situations where it's a very competitive process, where somebody else has been trying to create that sort of smooth outcome, and we get a call a little bit later than we would like, and all of those things are just part of the industry that we work in. And so we prepare ourselves for all of the outcomes, which is taking your time and going really slow, or if necessary, we pride ourselves on an ability to execute extremely fast when necessary. So we have bought companies in very quick turnarounds, in very competitive situations, and we feel like our ability to execute is a competitive advantage in such a way that if we have to move quickly, we can, and we can beat someone to the finish line. But it's never our preferred path. We'd always like it to be one-to-one and slow and steady.
Yeah, I think as an entrepreneur, it behooves you to try and get more than one person to the table. Like, how are you going to get the best price if you only have one bidder? And so my expectation is that if the entrepreneurs can do that, they're going to do that. And I certainly don't begrudge anybody for trying to do their job, which is maximize value for their shareholders. And it's certainly not kind of like optimal. Obviously, I want to pay the least amount of possible, and I will walk away. We do have walkaway prices like everybody, and so you don't want to be an entrepreneur that overplays your hand because you could blow it. Companies get hot about something, and then they get cold, and that's it. You've blown it. And so finessing that that's why I think experience in the VCs and, having a set of people that you can rely on is so important. Finessing that very important time, which might be a few days, might be a week, and not over, really playing it thoughtfully to do your job, to end up at a place where you're going to be happy to work with maybe for the rest of your life, to achieve your vision. Maybe it's just going to be for 3 or 4 years or whatever, but it's going to be a significant amount of time. And you have to kind of think about all your employees and where they're going to be happy. And you have to think about kind of your shareholders and making them happy. You have a tough job as a CEO, and I don't begrudge people for whatever process they do to kind of get to that.
Yeah, I mean, it's it's interesting to observe that the number of public companies in the technology space over the last 10 years has declined by almost 50%. And part of what has happened is the rich are getting richer, and there is not a second tier of aggressive, viable potential acquirers for many of these companies. I think there are fewer highly competitive deals today than there used to be, and I'm not sure when that will change, when it will come back.
I wish that was our experience.
No, there are people who are going to. Well, and you're in a little different corner of the market.
I feel like
too.
every deal is competitive.
Well, that's because we want you to think that.
Yeah. Exactly. Because to my inexperience. Exactly.
You know, if I can just make one comment on this, I think, the most important thing that you have as a repeat acquirer is your reputation. And part of that reputation is actually not being known as someone that's cheap. So we at Cisco, we don't mind paying a few extra dollars to get the right deal done and make everybody feel happy, because our experience absolutely says that the extra few bucks is not the determinant of success or failure. It's buying the right company. And so if you have a recurring reputation, and I would hope that most people would agree, Cisco, we certainly have lots of faults, but we usually are not called a cheap acquirer. And that's okay. It's so that when we get into a dialogue with a company, of course they're going to do their market checks and get a sense about what fair value is. And no one expects a company to sell for less than what they're worth. But what you want the CEO to know and the board to know is if they're dealing with you and you have a good reputation, that you'll treat them fairly in that process. And that's a repeat thing that happens over years and years and years. And so you always got to keep that in mind if you plan to be back in the market on the next deal.
Very good point. We've got time for, I think, a couple more.
Matt Fogarty, Crowdcast. If a competing corporation makes a venture investment in a startup, does that make it more interesting or less interesting for you in terms of M&A?
It goes back to my favorite answer, which is depends. It obviously depends on the rights that they are granted in connection with that investment. It depends on a bunch of factors, and so I can't say a priori which way I'll think about it. I'll certainly notice it. I'll certainly think about it. I'll think about the signaling effect. If Cisco has put money in a company, then it's something that I'd want to buy. Where in the process are they going to find out about it? Do I want that to happen? Do I care? So it has a lot of effects, but it's tough to say for me which way it goes.
So strings attached are a disaster?
No, not necessarily. Again, it depends on what the strings are. It's just, again, very complicated.
So, I can answer it from a little bit of a different perspective. As I said, we have a very active venture practice ourselves, and so we have the conversation on both sides of the table as a company talking to a startup or a company we're considering investing in, and talking through those trade-offs, and then also on the other side as an acquirer with different dynamics. And what we tell companies when we're considering making an investment, like everything, there are trade-offs. So you have Cisco as a partner early in your life cycle. There's a lot of positives that you get out of that, and when we do it right, we certainly add tremendous value in the relationships that we create with startups. But obviously there's also the other side of that, which is somebody who views Cisco as a direct competitor is going to have some trepidation about approaching you, and so you have to think about those goods and bads, and there are times when it doesn't make sense for a startup to take corporate money, and there are times when it does. You just need to be open-minded about the full life cycle of what that implies.
Rich, you want to add anything from?
Oh, I agree. I think that's exactly right. No, I think I have nothing else to add on that.
All right. Very good question.
Hi, Bill Sauter with Galaxy Ventures. My question has a little bit of overlap with the last one, but obviously this is somewhat determinant by the size and stature of the target company that you're looking at. But this is for all three of the corporate gentlemen. If you think about your own internal corporate development groups, your venture group, and maybe even business development, if you could just describe maybe some of the friendly internal competition and what sort of evaluation process you may go through of, should we buy this company? Should we invest in this company? Is it just a contractual relationship and the give and take that goes back and forth there?
David, do you want to?
Sure. Thanks. That's a good question. Kind of every approval process for a deal. Like every meeting that we have about an acquisition has a buy, build, partner slide. Like it's the fundamental essence to our thought process, and it's how you have to think about it. And I guess a lot of times you come to the conclusion that you can't get to market fast enough through building. Sometimes that's usually why you're in the room. If you could have built, then you probably have not had to go that far in an M&A discussion. So then you get into the buy versus partner, and you really need to understand what are the objectives of the business as a standalone business versus our own objectives at Google. So, just using the example of Maps Keyhole, because we know it, and I've used it a few times, it's easier. They were selling an enterprise product. They had enterprise customers to serve. That's not kind of where we wanted them to spend development resources. And so it was better for us to acquire the company and have all of their energies focused on the trajectory and the common goals that actually they wanted to pursue, which was this, kind of mapping the whole world. And so if you could achieve things through a partnership, well, that's definitely great and cheaper, and why wouldn't you do that? And Google has thousands of partnerships, kind of many multiples of the acquisitions that we do. So I would say that's the answer in the vast majority of cases. When M&A is kind of the best approach to achieve your goals, that's kind of when you do it.
If I can just add to that, we've tried very hard at Cisco to structure our organization in a way that is a very seamless discussion with the external company. So as I talked about up front, we have one organization that does the full gamut of relationships to external companies. So if you're talking to me or somebody on the team and you're a startup company and you're thinking Cisco potentially could be an investor in your company or an acquirer in your company, or in the partner case, help connect the dots to the right person in a business unit, you're talking to the same person. And that's a very important structural way in terms of how we approach the market, because I think there are situations where if you've got one person you need to talk to about a partnership, one person about an acquisition, and one person about a venture investment, obviously it's all at the same company, and if they do it well, they can make that seamless. It's easier if it's the same individual. And so we've tried very hard to structure ourselves to be sort of entrepreneur and third-party company friendly in the way that they have to navigate the big world of Cisco to figure out the optimal outcome for them in terms of those different relationships.
Anything else, Marc, on that?
No,
Yep. Okay, very good. We have time for one more.
You guys talked earlier about VCs in the M&A process. I'm curious to get your perspective as some seasoned deal makers on use of investment banks in M&A process.
Absolutely essential, right? No, that's not what they're going to say. Who wants to go first?
I'll go first then. Unlike my comment about the venture capitalist, where it depends, it very much it depends as well. I will say the flavor of the depending tends to be negative in my mind, but what usually happens is we talked about it before. It's a competitive situation is the result, and that's what a banker does. They're going to try by whatever means necessary to make sure that the company does get its highest and best price, and that will be a market check. That will be various things which put more pressure on the price that I need to pay to get the deal done. So from the price perspective, I'd rather not deal with investment bankers. I also find the ones who are good also know both how to run a process to make it fair for everyone. That's a benefit for me in some cases. The good bankers also know and can help, as David was talking about with the VC. They've done it many times. They can help a board and an unseasoned entrepreneur make decisions quickly, efficiently, and make the overall process better for everyone. So there are definite positives. Again, price and sometimes getting in the way of conversations because they want to control too much can be some of the downsides.
Massive. That's a massive point, I think, that last point. Anything that prevents the natural dialogue between the company and the entrepreneur impacts our conviction, which impacts price. So I would say in almost every circumstance, that where there's been a banker, it took us all, we probably bid less than we would have otherwise. Like it's just, we just don't know because we're not talking to the principals as much, and I find almost invariably it hurts the process.
Well, speak up and try to assist my colleague.
Well, there are bankers and there are bankers, right?
I'm saying in our experience.
I think it depends. I think it's very situation specific. Right? I think, for example, if the VCs themselves kind of know all the likely acquirers of a particular category, you can probably make the connections. And running a process isn't the hardest thing in the world if you know exactly who you're trying to reach. But in some cases, you don't necessarily know you don't know everybody that you really need to know if you just, a couple of VCs on the board or the entrepreneur themselves. And sometimes it's very helpful to get the introductions made to a set of the other folks that you might need to reach out to. I think, as a photo or a mirror comment to the one I made earlier, I think certain bankers are known as having a professional, disciplined, fair process. And I think those reputations get established over time and are well known by this community. And others have other reputations, and I think over the course of time that doesn't always help the companies. But I can say, in situations like whether a company is debating, should we consider an IPO in a year, or should we consider maybe a offer that's come across the table that we weren't expecting? Sometimes the VCs don't have the experience to judge between the receptiveness of the public market versus the private offers, and if it's come as a surprise, we may not have sort of been teeing up all the conversations to get the other discussions going, and so there's a lot of scenarios where I believe it could certainly make sense.
Yeah, it doesn't make sense all the time, despite my comment to the contrary. And I would also say that any banker who thinks they should control the conversation between the two parties is badly misdirected. I mean, that's naive. The merit of these connections is the people who are going to live together after the marriage. And you want to open the door and get out of the way. And, you make counsel from the background and so on. Okay, that's almost exactly on time. And thank you for being so involved in this and sticking through all of our commentary. Thank you very much to the four panelists who I thought did a marvelous job. And again to the club and Skadden Arps and Microsoft for the facility. This is great fun for us. I trust that some of you will want to make a connection up here. Feel free to come up and chat after the event. I don't know how long they keep the lights on, but for a while, I presume. And we'll look forward to doing this again sometime. Thanks, Karen.
So on behalf of our audience and the club, before you race off here, want to echo our thanks. And as a token of our appreciation, we have a stylish and well-made Churchill Club T-shirt for you. Please wear it in good health. Thank you, Skadden. Thank you, Microsoft. And thank you all for coming. Good night.